So if we look at this pie chart over here, you can see that 73% of the people renewing is coming from a 5-year fixed. 18% of them is coming from less than that. And then you have that 9% of the people renewing with the vintage of a variable with a fixed rate payment. For anyone who's watching this, if you have a variable rate that you got around 2021 or 2022 at TD, BMO, RBC, or CIBC, you may not actually know your mortgage is actually increasing if you haven't been following the news. And I'm concerned that anyone who doesn't know may get that sticker shock, because even if rates are slightly lower, what has happened is that the mortgage has grown, which means that the payments will grow and the interest rate will ultimately still be higher than what they got during the pandemic. And that's where I may think there could be some problems to be had. If you're one of the 60% of Canadians renewing a mortgage by 2026, you're in for a wake-up call. The Bank of Canada just dropped a report and it's not very pretty. Some payments could jump 15 to 20%. So let's break this down and what this means for your wallet, your renewals, and your next move. Hi, my name is Zen, and I'm enjoying my data-driven and number-crunching real estate updates. Be sure to like and subscribe. 60% of Canadian mortgage owners could face higher mortgage payments by 2026, and this is according to Bank of Canada's latest report. One of the key findings in that report is that it estimates that in 2025, so by the end of this year, homeowners renewing their mortgage are going to see an increase of 10% on their monthly payments compared to what it was last year in Q4, so in 2024. So in short, what it basically means is that rates have gone up from the same time last year. So a lot of Canadians have to watch out. But how big of an impact is this really going to be on the real estate market? And this is exactly what I'm going to break down for you. So this link right here is the actual Bank of Canada's report that they came out with that I'm going to go through with you. And there are two things I want to highlight over here that are important, because when we break it down, there could be subcategories or subcategories. So the first one is that they're making an assumption that borrowers that generally have a 5-year fix are going to go into a 5-year fix, because that's the most common type of mortgage product that most Canadians have gotten, and they're going to assume the same thing going forward. The second thing is that this is exactly what the article was referencing, that 10% of higher payments in 2025 and 6% higher for those renewing in 2026, which means that in Bank of Canada's assessment, they believe that rates are going to be actually coming down. They're just going to be elevated right now. Of course, I'm just going to preface all this by saying that nobody has any crystal ball of where rates are going to be. People thought we're going to have more rate cuts in July and September, and right now it seems like that's not on the table at the moment. Now, this chart I'm going to show you is basically what the Bank of Canada's expected interest rate is going to be. So on the left-hand side, so the y-axis over here, this is your actual interest rate. So 1%, 2%, 3%, 4%, 5%. And then on the x-axis is you have in the year. So anything that's in this gray band over here is effectively their prediction. So this green solid line over here is what we call the policy interest rate. This is what the Bank of Canada controls. And I've made many videos about this. The Bank of Canada controls the variable rate. So when it comes down, it goes along with the variable rate and it chases it down. However, if you are going to be getting a fixed rate mortgage, it's generally tied to the bond market, which the Bank of Canada does not control, and it's to go along with financial markets. Usually we follow the US. So you can see in this chart over here that the green line, we were as high as 5%. We're coming down, we're coming down, we're coming down. We're right here about 2.75. So Bank of Canada themselves are actually predicting that the interest rate is going to be cut by another 50 basis points or 2 more cuts by January 2026 over here. And you can see that they're going to go up a little bit after, so maybe 25 basis points. Again, this is 2 years from now. A lot of things can happen. That's for the variable. Now let's look at the fixed. So the fixed rate is tied to the current 5-year bond right now at 3.87. It's as low as right now the 2.61. But here where you're going to see is that the 5-year bond is going this way. So what Bank of Canada is saying in their prediction models is that, hey, maybe the lowest of the fixed rates are here and it's moving up. So is there a lot of concern given what Bank of Canada's prediction is? And the answer is no. Because historically, the variable rate has been lower than the fixed. Most Canadians in the last 10 years have been paying a slight premium on top of the variable to get that, peace of mind. It's only in the last 2-3 years where the fixed has been lower or on par with the variable because of a lot of reasons I'm not going to get into this video. But it looks like things based on Bank of Canada's report and prediction, they're going to go back to the norm where there's a slight premium on fixed and the variable a little bit lower than that. which is a whole different topic that I'm going to get into next video about the differences of what most people know and don't actually know about getting a fixed rate mortgage versus a variable mortgage, because people are just so focused on the Bank of Canada's announcement, which isn't actually the end all be all. So if you want to understand the nitty gritty of how to pick the proper mortgage for whatever your unique situation is, make sure to stay subscribed to the Prime Props channel, as I will be releasing that video later this week. Now, in their findings, they're saying that 75% that have a 5-year fixed mortgage rate is going to have a payment increase. Now, remember, you're going to get, by their prediction, an average of 10% increase on your monthly mortgage. Chart I found very interesting because it's going to apply to whether people believe in the fact that, hey, we always have had this mortgage renewal cliff. And they have more data about who is going to see an increase in payment right now. So you can see in this chart over here, which is the 2025 chart, you can see that of all the mortgage borrowers renewing, there's going to be about 11% of them are actually going to see a decrease. And if you're wondering why, it's just because people are maybe coming out of a higher fixed rate mortgage. You're also going to see about majority of them, 71%, actually have no change in their payment at all. It's going to stay the same. Now, of the 100%, 18.3% of them are going to see the mortgage actually go up. And this is by the end of 2025. So it's not like there's a huge amount of people that are going to see a huge surge in their mortgage payments on a monthly basis upon renewal in 2025. And that's what we're seeing right now. Now, it's a different story when it comes to the end of 2026. Because remember, rates started going up in 2022 of March. So when you apply 5 years from that, it basically puts you in like Q1 of 2027. So they're saying at the end of 2026, which is basically the lowest the fixed rates were at, these were like your 1.5% fixed years at like Q4 2021, this is where this chart comes in. So you can see that it's funny, you're actually going to get 23% with a mortgage payment decrease. Didn't really see that coming. You're going to have 42% of them not have any payment increase, and then you're going to have 33 with a payment increase. So basically what I would say is happening in the 2026 renewal kind of vintage is that you got like a chunk of people who are going to go and hit here where they actually have a payment decrease. These will be your shorter terms that they got in like 2023 when the rates were higher than what they are right now. And then you have some vintages that are from the 5-year that are going to here where they're actually going to have their payments increase. Now, the question a lot of people will be asking right now is like, hey, is this 33% of the mortgage renewal going to affect the real estate market, or is it going to be a surge in people wanting to sell? And I would say that really depends on kind of where the economy is, because if we're seeing a, call it average of 10% increase, I don't think 10% monthly mortgage increase of the 33% that are actually renewing is going to move the market that much in terms of how much inventory. Because you have to remember, this is Canadian centric. Now, are there going to be fringe cases where we're going to see people have to sell because maybe they're over levered or because they're coming from a different type of mortgage where it actually went up more than 10%? Yeah, 100% that's going to happen. Because if you look at this chart here, this is going to explain which percentage of them is actually going to have a lot of problems on the renewal. So you can see over here, the blue spot is going to be fixed rate terms of less than 5 years. The yellow is going to be 5 years or more, which is a majority of the conventional mortgages that most Canadians get. And then here you have the one that I really think is going to be in trouble, which is the variable rate with the fixed payments. So this is if you have a variable rate with the banks such as TD, BMO, RBC, CIBC, those are the big ones. It means that your variable rate has not actually increased with the interest rates going up. You actually pay the same amount, but then the interest you owe gets added on to the balance of your mortgage, which means that you're not actually paying down the mortgage and it's increasing. So this is, if you remember from a year or two ago, where there's a lot of headlines saying this person has a 99-year mortgage or amortization, this person has a 60-year amortization. This is that vintage of mortgages that could be problematic. So if we look at this pie chart over here, you can see that 73% of the people renewing is coming from a 5-year fixed. 18% of them is coming from less than that. And then you have that 9% of the people renewing with the vintage of a variable with a fixed rate payment. For anyone who's watching this, if you have a variable rate that you got around 2021 or 2022 at TD, BMO, RBC, or CIBC, you may not actually know your mortgage is actually increasing if you haven't been following the news. And I'm concerned that anyone who doesn't know may get that sticker shock, because even if rates are slightly lower, what has happened is that the mortgage has grown, which means that the payments will grow and the interest rate will ultimately still be higher than what they got during the pandemic. And that's where I may think there could be some problems to be had. Before you even think about selling, don't let another chatbot price your biggest asset. Your property is not just another number. Hit the link in the description below and I'll send you a personalized assessment with real data and expert insights so you can sell with confidence on your terms. Now, on the flip side, who is renewing that's going to be having the mortgage payments come down? And you can see over here, exact same chart, but the circle looks different. So you can see more than 50% of the people who are renewing is going to have their monthly mortgage payment go down. This is for those who have a fixed rate mortgage term of less than 5 years. So like what I was saying, people who got a fixed rate in like 2022, like second half, or 2023 or 2024, they're going to have their mortgage payments come down. Then you have the red one here, which we didn't see prior, which is the people with a regular variable rate with variable payments. So these are people at Scotia or National, where when the interest rates went up, so too did the mortgage payments, and they kind of just rode the craziness that happened. And ironically, there's actually a decent portion of people who had a variable fixed rate payments and it will come down. My suspicion is that's going to be the RBC cohort, where they had to always pay the interest, but they could have just paid $1 on their principal. So their payments will come down for that reason. So in general, having seen all of that information, you can see that the 5-year fixed mortgages, people renewing into it, which make up 40% of all the mortgages in Canada, they are going to be seeing some kind of increase even in 2026 for up to about 20%, which I will tell you right now, most of them would have been stress tested for it. So they should generally be okay. Where we are going to have issues are the variable fixed payments, like I was saying earlier, and this is exactly what the BNN Bloomberg article is reporting. Meanwhile, those with the variable rate mortgages with fixed payments may see mixed outcomes. About 10% of those borrowers are expected to face an increase of more than 40%. And this is exactly where that article got it from. These are your people who got a very, very low variable rate. They haven't made any additional payments to get caught up, and they're negative amortizing, and they're coming from, say, like a 1.5 or a 2% rate going up to a 4% rate right now. And that's where we're going to see the 40% mortgage payment increase. Now, this chart here, I really had to dig down into the Bank of Canada's report to find out. And I really don't think anyone's going to be reporting on it, but I actually think it's one of the most important charts of the analysis that I have here. And what this chart is basically talking about is that which borrowers who got that variable mortgage rate but has a fixed payment that have challenges and may potentially be facing that 4% mortgage monthly increase, and how many of them actually start repaying their mortgage principal so that they are actually caught up on the negative amortization. So this is a chart that kind of talks about it. So you can see that as a percentage of borrowers who fall into that kind of bucket of variable rate fixed payment, this is that percentage on the y-axis over here. So you can get as high as about 12.3% of borrowers nationally in Canada that fall into that bucket, which jives with their previous data. Now, the blue observed share basically talks about how many actual people that they saw make a payment to their negative amortizing. So what the important line that you have to understand in this chart here is this one right here, where it says 0. So anything that falls to the left side of this 0 means that the mortgage is increasing. Anything that falls to the right side of the red line means that the mortgage is being paid down, because 0 basically represents the mortgage not moving. A negative number, so to negative 10, means that the mortgage is growing. And anything towards, say, even 70% means that that borrower has paid off 70% of the remaining balance. Even in Bank of Canada's simulated scenario, they thought at some point 10% of the borrowers would have a negative amortizing mortgage, which is quite a lot. And eventually Bank of Canada thought that they would actually start paying it, and 13% of them would actually pay a certain amount. Now, how much they're going to be paying? Let's say they would pay somewhere between 0 and 3%. Now, what they actually saw was that in the blue line has actually moved to the right, which means that more people have paid more of their mortgage. So you can see at this point over here where the yellow and the blue, that's kind of where the things cross. But where Bank of Canada made an error on their prediction model or their simulated percentage of people who paid it back is that more and more people, so call it 8% of the people, would have made at least 5% of the mortgage payment to it. And as that percentage shrinks down to like 6% or 4% of the borrowers, they actually make more of that mortgage payment. So as an example, if we get to here, 2% of the borrowers, and these had the variable fixed rate, have actually made a lump sum payment of 10% of the total outstanding debt. And you can see that this amount is actually surprisingly high. So what does this ultimately mean? It means that those who had the variable fixed rate mortgage actually had money to do a lump sum payment and reduce the mortgage debt. So are there going to be people who are out there that may run into issues with this type of mortgage? 100%. But based on this chart over here, where the blue line is over the yellow line, it means that Bank of Canada didn't expect this many people to be prepaying their mortgage debt when they had this variable fixed rate mortgage, which ultimately means that there's more money in the Toronto real estate market than those who would have actually thought. And I've been preaching this for quite some time. Not everyone who has a variable rate mortgage with a fixed payment is going to basically have to fire sell their property because they have money to service that additional debt. And you can see it over here when the blue line is above the yellow line. And you can see over here, basically 1% of all mortgage borrowers would have made a 17% lump sum payment, or almost 20% or a fifth of their mortgage in that duration that they're measuring this. So there is some money in the system. You just have to understand that. And this is why ultimately I agree with Bank of Canada's findings. And I've been saying this in previous videos. The mortgage deferral cliff, while there are 100% going to be people who are affected and they're going to have to sell it, it's not going to be enough of sellers who need to fire sell or are super distressed to let go of their property, because there won't be that many people in that situation. Because a lot of people who got the type of mortgage where they are potentially in trouble, the variable fixed rate, actually have the money to service them or make a pre-lump sum payment to reduce that negative amortization. So this is exactly why Bank of Canada says, we do not expect the upcoming mortgage renewals will lead to a severe worsening of financial stress for the affected borrowers, holding everything else constant based on their assumptions. And indeed, most borrowers will likely have higher income at renewal and should face interest rates below what they were stress test for. That's the key thing. And the stress test rate is 5.25, and we're at 4 right now. And this is the important thing that I've been saying for a very long time. Some borrowers with higher payments at renewal will face challenges, and most of them will basically need to change their spending because of the higher mortgage payment, which will slow down the economy. And some may struggle to meet their financial obligation, which is basically making their monthly mortgage payment. And this is exactly why I was saying in the previous video, it doesn't really matter whether the Bank of Canada cuts the rates in July or not. Whether they cut or hold, even if they cut or hold in September, the current mortgage rates that are in the real estate market, it's neither stimulative or depressing the market. It's just going to stay exactly the same thing. So if you want to understand how the latest inflation print affects the mortgage rates and how it affects the real estate market, make sure to check out the video that's on the screen right here. I'll see you in that video. Until next time, your move, your future. See ya.